Hey everyone, and welcome! Today we are going to dive into one of the most powerful and yet one of the simplest ideas in all of finance. We're going to break down exactly how you can start building some serious, life-changing wealth, not with thousands of dollars, but with a single $100 bill.
So let me just ask you that straight up. What if everything you've ever heard about needing a ton of money to get started was just wrong? What if your path to a truly secure financial future could begin today with the same amount of money you might spend on a nice dinner out? Stick with me because that is exactly what we're about to break down.
So how do you do it? Well, the answer lies in this simple, kind of brilliant tool called an index fund. Seriously, for beginners, this isn't just another option, it's pretty much the secret weapon for building wealth without all the usual headaches and complexity. Okay, so what even is it? Well, think about the S&P 500. You've heard of it, right? It's basically just a list of the 500 biggest, most successful companies in the US. We're talking Apple, Microsoft, Amazon, all the big players. An S&P 500 index fund just goes out and buys all 500 of those stocks for you. So with one single purchase, boom, you instantly own a tiny slice of the entire top tier of the American economy. Now, this really gets to the heart of it. There are two totally different ways to think about investing. On one side, you've got stock picking. That's the whole game of trying to find that one needle in a haystack, that next Amazon, which, by the way, even the pros on Wall Street are really bad at. But on the other side, you have index fund investing. And with this, you're not betting on a single company at all. You're just making one big, simple bet that the entire economy, as a whole, is going to keep growing over time. And this is exactly why they're so perfect for beginners. For one, you get instant diversification. Owning 500+ companies at once protects you if one or two of them have a really bad year. Two, they basically run on autopilot. They just track the market. And three, and this is absolutely crucial, the fees are incredibly low. We're talking practically zero. Why? Because you're not paying some fancy manager to guess which stocks to buy. And lower fees mean more of your money stays invested and gets to work for you. Okay, I know what some of you are probably thinking right now. You get the logic, but you're still a little skeptical that a small amount of money can actually make a real difference. Well, this is where the real magic happens. Let's talk about the power of compounding. This is the #1 mental block that stops people from starting. And you know what? It's a totally fair question. But the answer isn't really about the size of that first investment. It's all about what happens when you combine that money with two other things: time and consistency. So let's build a real-world example, step by step. We're going to start with this number, $100. Not a huge lump sum, just $100 invested automatically every single month. Next, we add the most powerful ingredient in all of finance, time. Let's imagine you start this simple habit when you're 25 and you just let it run for 40 years, all the way until you're 65. You don't do anything fancy, you just stick with it. And finally, we add the fuel for the fire. We're going to use the historical average annual return of the S&P 500. Over the last century or so, it's been right around 10% a year. Now, some years are up, some years are down, but that's the long-term average. So what happens when you combine those three simple ingredients? You get this, over $630,000. That is the power of compound growth. It's your money earning money, and then that new money starts earning its own money, just snowballing over decades into a truly life-changing amount. But honestly, the final number isn't even the most important lesson here. The real takeaway is that the people who successfully build wealth don't wait until they have the perfect amount of money to start. They're the ones who just start early, build a habit, and stay consistent. They plant that seed even when it feels really small. Okay, so hopefully you're convinced on the why. Now let's get super practical and talk about the what. This is where people can get a little overwhelmed, but don't worry, we're going to keep it to just 4 simple, really powerful options to get you started. Just look at this list. VOO is kind of the gold standard. It tracks the S&P 500 for a tiny fee of 0.03%. That's literally 3 cents a year for every $100 you invest. It's wild. Then you've got FCROX from Fidelity, which covers the entire US market, and get this, has a fee of 0. It costs you nothing to own. SCHB is Schwab's version, also fantastic. And if you want to bet on the entire world economy, not just the US, VT covers over 9,000 companies from all over the globe. You honestly cannot go wrong with any one of these. All right, you know what to buy. Now where do you actually go to buy it? Let's make this super simple. This is it. This is your entire launch plan. Step 1. Pick one of the big 3, Fidelity, Schwab, or Vanguard. They're all excellent, low cost, and super beginner friendly. Step 2, open an account. It is totally free and takes less than 15 minutes to do online. Step 3, link your bank account. And step 4, and this is the most important step of all, automate it. Set up automatic transfers for every week or every month, even if it's just $25. Automate the habit so you don't even have to think about it.
Now, before we wrap this up, I want to arm you with a little bit of final wisdom, because knowing what not to do is just as important as knowing what to do. So let's quickly cover the 4 biggest mistakes that beginners make. First up, waiting. Waiting for the market to dip, waiting until you have more money, waiting until things feel certain. Look, let me just tell you, there is never a perfect time. Every single month that you wait is a month that your money is not compounding for you. The best time to start investing was yesterday. The second best time is right now. The second mistake is getting obsessed with checking your account every single day. I know it's tempting, but the day-to-day ups and downs are just noise. You are a long-term investor, not a day trader. Checking it constantly is only going to stress you out and probably cause you to make a bad emotional decision.
And that brings us to the biggest mistake of all, panic selling. The market will drop. It's a completely normal part of the cycle. But history has shown us time and time again that every single market crash has eventually recovered and gone on to reach new highs. When the market is down, smart long-term investors don't sell. They actually see it as a sale, and they keep on buying.
And finally, please do not overcomplicate this. You do not need 10 different funds or some complex, fancy strategy. Usually, the people who make it complicated are just trying to sell you something. 1 or 2 broad market index funds, consistent contributions, and time. That's it. That is the entire strategy. So, to bring it all home, just remember, index funds are your ticket to simple, effective investing. You can absolutely start small. Use one of the funds and platforms we talked about, automate it, and then just be patient. Wealth isn't built overnight. It's built one decision, one investment, and 1 month at a time.
So I'll leave you with this one question. The knowledge is yours now. The path forward is crystal clear. Are you going to be the person who takes that first simple step and invests your first $100 this week? I really hope you are. Thanks for joining me.